Foreclosures are exploding across America. This time, it's not the poor being crushed first. It's the middle and upper class. Almost 1 million homeowners are already behind on their payments. Layoffs have hit tech, retail, and manufacturing industries hard. Families now face eviction notices on homes they thought were safe forever. Foreclosure filings have jumped 5.8% in just 6 months. Credit delinquencies have reached 7.18%, the same level as before the 2008 crash. The storm is already here, and it's growing stronger every month. What's coming could be the biggest housing collapse in 15 years. Something dark is moving under America's housing market. It's much bigger than just high mortgage rates or unaffordable homes. Foreclosures are rising faster than Wall Street expected. In early 2025, over 187,000 properties received foreclosure filings. That number is 5.8% higher than last year. Each percentage point means thousands of families losing their homes. The pace is accelerating. In March, filings rose 9%. In April, they jumped 13.9%. By August, they were up nearly 18% compared to last year. This isn't a wave anymore. It's a rising flood. Most people still believe the housing market is strong. They think it's fine because prices haven't crashed yet. But that belief is the biggest illusion. Beneath those prices is a credit crisis choking the system. Nearly 1 million homeowners are behind on payments. That's 1 million ticking time bombs waiting to explode. The average 30-year mortgage rate is around 6.3%. Millions can't refinance their homes anymore. The median home price is $422,600. That needs an $85,000 down payment, which most can't afford. The Housing Affordability Index has fallen to 94.4. That means average families can't buy average homes. Consumer debt has hit $18 trillion, the highest in history. Credit card debt alone is $1.2 trillion. Over 7% of credit cards are now more than 90 days overdue. Americans are running out of financial lifelines. Mortgage defaults always follow credit card defaults. The same pattern happened before the 2008 crash. This crisis hides behind corporate optimism and government talk. The media calls it a soft landing. Economists call it a correction. But the data tells a different story. Inflation stays above 2.9%. Wages are flat while layoffs spread everywhere. Every job lost pushes another family closer to losing their home. This isn't random hardship. It's the start of a system-wide breakdown. When high debt meets job loss and low affordability, foreclosures explode. And that explosion has already begun. The crisis is clearly visible in Florida. Once a paradise for homeowners, it's now the foreclosure capital. 1 in every 267 homes is in foreclosure. Orlando faces 1 in every 234 homes. Jacksonville, 1 in 241. Miami, 1 in 247. Behind these numbers is an economy collapsing from inside. It's not just job loss or reckless spending. It's the cost of living spinning out of control. Insurance premiums in Florida have jumped 25% in 1 year. Thousands now must choose between paying the bank or the insurer. Property taxes are rising faster than anywhere else in the nation. Even condo owners face huge new repair fees after new safety laws. These are not short-term problems. They are structural cracks forcing people into default. Florida's foreclosure filings are up 36% since mid-2024. And the trend is getting faster. The same population boom that once helped Florida is now hurting it. Insurance companies are leaving the state. Maintenance costs are rising beyond control. The median home price in Florida is $420,000. But the median household income is only $70,000. That gap is too big to survive. Even good loans have become impossible to maintain. Florida is now the perfect storm of economic pressure. High costs, inflated home values, and climate risks combine. This is not just Florida's problem. It's a warning for the entire country. The same pressure is hitting many other states too. The crisis that was hidden is now visible across the nation. Alaska's foreclosure activity is up 55%. Rhode Island is up 51%, and Wyoming 46% in months. These are not random spikes. They are signs of deeper economic weakness spreading fast. From energy states to industrial areas, the pattern is the same. When many states collapse together, the crisis becomes national. In Alaska, oil revenues are falling while costs rise above 6% a year. In Rhode Island, factory jobs are vanishing due to automation. Wyoming homes move from late payments to auction in just 125 days. In Louisiana, the process takes 10 years. Some states collapse overnight, others slowly rot away. Florida's Lakeland now has one foreclosure for every 172 homes. Atlantic City and Columbia, South Carolina, also cross 1 in 200. This data reveals where the housing market is weakest. Even though total foreclosure rates look low, the growth rate is alarming. The current speed matches 2007 before the global crash. A national unraveling has quietly begun. This time, the cracks are spreading everywhere at once. From Alaska's oil towns to Florida's flooded suburbs, the story repeats. Rising costs, falling incomes, and increasing debt are everywhere. The housing market is splintering across the country. And the danger now reaches even high-income families. The myth that six-figure earners are safe is gone. Since early 2025, major companies have laid off thousands. Intel cut 24,000 jobs, Microsoft 15,000, and Amazon 14,000. Meta and Google also removed entire teams. These are not minimum wage workers. They are families earning $200,000 a year now losing their homes. This silent wave of layoffs is deeply destructive. The unemployment rate of 4.3% hides the real story. High income stability is disappearing fast. Each engineer or manager who loses a job means a mortgage unpaid. 94% of housing prices depend on employment levels. When white-collar layoffs rise, the housing market breaks from the top. Mortgage delinquencies among tech workers are now 4% higher than average. Cities like Seattle, Austin, and San Jose are seeing early foreclosures. The illusion of safe tech jobs has been replaced with repossessions. These workers had big debts, big homes, and high credit scores. When they default, the system feels it. Banks lose their best borrowers and confidence starts to fall. Liquidity shrinks and home values begin to drop. This is how financial contagion moves through the middle class. One engineer's job loss becomes one more mortgage default. Multiply that by thousands and the damage spreads silently. America's housing market is not just under stress. It's breaking, slowly and quietly, from the inside out. Corporate profits are falling and tax money is shrinking. Foreclosures are spreading beyond tech cities into nearby suburbs. The layoffs people thought were temporary are now becoming permanent. The stability of America's professional class is breaking apart fast. This group was the backbone of the housing market. Now, their financial security is dissolving in real time. This is not a small slowdown. It's a controlled demolition of middle-class wealth. The collapse of high-income stability is feeding a bigger problem. America's debt spiral is speeding up. As layoffs increase and mortgage delays rise, families lose their safety nets. Total household debt has now passed $18 trillion, the highest in U.S. history. Out of that, $1.2 trillion is credit card debt, the most expensive kind. The average credit card now charges over 22% interest per year. Even a $10,000 balance costs more than $2,000 in interest every year. The real danger hides below the surface. Over 7% of all credit card debt is more than 90 days late. That number is exactly what we saw before the 2008 crash. This is not random, it's the same pattern repeating. Mortgage defaults usually follow credit card defaults within 6 to 9 months. Millions of Americans now use credit cards just to survive. They use them to pay bills, groceries, and even mortgage payments. Every swipe delays the crash, but only for a short time. Inflation may look low at 2.9%, but it still hurts the middle class. Real wages are not rising, while costs keep going up. Interest rates are near 6.35%, trapping millions of homeowners. People who bought homes when rates were 3% can't refinance now. They're stuck paying double if they try to move or refinance. This lock-in effect now traps 60% of all mortgage holders. It freezes home supply and weakens the market's liquidity. Banks are quietly cutting credit limits and raising minimum payments. That makes things worse for families already struggling. When credit access shrinks, delinquency rates rise even faster. The system is now eating itself from the inside. The Federal Reserve's small rate cuts are not fixing the problem. The issue is not money policy, it's structure. Too much debt, not enough income, and too little time left to fix it. Layoffs cut income. Inflation destroys savings. Credit cards become lifeboats that sink under pressure. Each missed payment pushes another family closer to default. Each foreclosure adds more weight to a system ready to break. America's economy is not slowing, it's suffocating under debt. And once this spiral gains momentum, no rate cut can stop it. This is not another 2008. That crash came from bad loans and risky banks. This one is built on real costs, high interest, and frozen wages. The Federal Reserve may have lowered rates to 4.25%, but mortgage rates are still stuck around 6.35%. Millions remain locked into homes they can't afford to keep or sell. It's a slow kind of financial suffocation. On paper, the housing market looks fine. Prices haven't collapsed yet, sitting around $422,000. But that's only because supply is limited, not because demand is strong. Homeowners hold about $33 trillion in equity, but it's not real cash. That equity is getting eaten by inflation, taxes, and rising insurance costs. In states like Florida, insurance premiums jumped 25% in 1 year. For many, home ownership is now a financial trap, not a dream. The Housing Affordability Index is just 94. That means an average family can't afford an average home. Younger people are being pushed out of the market completely. First-time buyers now make up only 24% of the market, a record low. The average first-time buyer is now 38 years old. That's almost 10 years older than in 2010. This isn't progress. It's a generational lockout. Homeowners aren't losing houses to bad loans anymore. They're losing them because life has become too expensive. Costs rise, wages freeze, and savings vanish. The result is the same people can't keep their homes. On top of that, insurance failures, student debt, and frozen supply add pressure. Together, these forces are creating a cage around the housing market. This time, the crash won't start with the poor. It will begin with those who thought they were safe, the middle and upper-class homeowners. This isn't a bubble waiting to pop. It's a slow and painful squeeze that's already happening. 2025 is not a copy of 2008. It's more dangerous and much harder to fix. Because this time, the system itself is broken. And as it unravels, one truth becomes clear: collapse always creates opportunity. Behind the rising foreclosure numbers lies a new landscape. Bank-owned homes are selling 20% to 40% below market value. In some struggling areas, discounts reach 60%. What looks like disaster to most is opportunity for the prepared. Over 36,000 bank-owned properties are already up for sale. The number is still below 2010 levels but rising fast. California, Illinois, Pennsylvania, Michigan, and Texas lead the trend. These are now the core states of America's distressed housing. They're not dying markets, they're shifting markets. Big investors already see this and are quietly buying. Hedge funds and private equity are collecting assets while others panic. Smart money always moves before the public notices. Fix and flip profits are now averaging $70,000 per deal. That's nearly 29% return on investment. Cheaper homes under $225,000 bring nearly 46% profit. In cities like Buffalo, returns reach over 120%. Markets aren't dying, they're resetting. Even small investors can enter with $25,000 to $50,000. Wholesaling and assignment deals offer quick profits without ownership. Those with more capital can earn big through flips in undervalued cities. Cash buyers now make up 63% of successful deals. They skip loan delays and inflation risks. While fear freezes the crowd, capital is reorganizing quietly. Every foreclosure and layoff shifts wealth from one side to another. In every downturn, the unprepared lose and the informed build wealth. The numbers don't show chaos, they show change. Major institutions now predict very different futures for 2025. Goldman Sachs, JP Morgan, Zillow, and NAR all disagree on what's coming. But none of them see stability ahead. Some expect small growth, others see decline or recession. When the biggest banks can't agree, it means the system is fragile. Mortgage rate forecasts also show confusion. Fannie Mae expects rates to stay near 6% through 2026. That means the dream of low-interest home loans is gone for good. Housing will no longer be a common dream, it will be a luxury. If rates stay high and wages stay flat, foreclosures could rise 25% more in 1 year. That would mean over 250,000 filings every 6 months. Defaults will rise, home prices will fall, and investors will buy cheap. Inflation keeps making everything worse. Even at 2.9%, it keeps eroding real buying power. Costs rise, debts pile up, and people fall behind. Demand falls, prices drop, and panic spreads. It's a slow-motion correction that optimism can't stop. This is not a short-term dip. It's a long-term shift from personal ownership to corporate control. The housing market is not stabilizing, it's restructuring. Everything points in one direction: a silent collapse disguised as stability. The illusion of control is the only thing left. Behind calm headlines, the system is breaking. Nearly 1 million homeowners are already late on payments. Foreclosures rise every month, and debt keeps hitting new records. The warning signs are no longer hidden, they're everywhere. The Federal Reserve has no tools left. Rate cuts can't fix broken wallets. Stimulus checks can't fix collapsing affordability. When debt grows faster than income for years, the result isn't recovery, it's a reset. This reset won't come as a crash like 2008. It will move slowly, quietly, and painfully. Home values will stop growing, liquidity will fade, and ownership will shift from people to corporations. Every modern collapse begins in silence, not panic. The middle class is already taking the hit. High mortgage rates, rising insurance costs, and heavy credit debt. All roads now lead to one end: a deep correction that reshapes the idea of home ownership. This isn't just a downturn. It's the start of a new housing order. Big investors already understand this cycle. They are preparing while the public looks away. By the time the media admits the truth, the best opportunities will already be gone. Every collapse follows the same rule. People ignore the warnings until it's too late. The next year will decide who loses everything and who rebuilds from the ashes.